And the Fed is out of the way. Thank you very much, U.S. Central Bank. Kind of a mixed response around markets, but generally the market's concluding that the Fed was a little bit on the dovish side of expectations. But the central bank marathon is far from over because we have the bookend waiting in the wings. And that's what we're going to focus on here today. I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. And our focus this week, after a flurry of activity from major central banks, we've had Australia give us a policy announcement, Japan give us an explosive one, the Fed today, another round of fireworks in the markets. And now we turn to the Bank of England because we are not done. And this too can have an interesting impact on financial markets. What we're going to do is explore what is expected here, see how it might influence the Bank of England in its decision making, and then see what that looks like from a trading perspective and actually look at some practical levels to trade this hands on. So let's begin with getting our bearings on the expectations. We're looking to see rates on hold at 5.25%. The key then becomes the voting pattern. Now, if you're not as nerdy as I am when it comes to watching central banks, the Bank of England has a pretty interesting structure. Whereas typically, let's say if you look at the Fed or you look at the ECB, there's a kind of process of policymakers getting together behind closed doors, hashing out consensus, and then the president in the case of the ECB or the chair in the case of the Fed, the governor in the case of the RBA or the Bank of Canada, comes out and sort of distills the consensus view. But rarely do we get a look, even when we look at the transcripts or the odd Fed policy maker dissents from the consensus, rarely do we get a kind of clear perspective on who voted how, and rarely is it one policymaker, one vote, to where even if the governor, in this case, for the Bank of England, the equivalent of a Fed chair or an ECB president, were to vote a certain way, but end up in the minority, he or she could be overruled. So the makeup of the voting pattern here, very important, and a telling sign of things to come, usually. So what we're looking for here is a slight nudge in a more dovish direction, a move in the direction of rate cuts becoming closer at hand by a bit. And so what you see here is there's 9 members on the MPC, the Monetary Policy Committee of the Bank of England, and the expectation is that we're going to see one of them continue voting for a cut. That's the smallest minority. But the consensus on unchanged is seen shifting from 6 out of 9 to 7 out of 9 as one of the votes for hikes leaves that camp and moves from voting for an increase, 2 out of 9 voted for an increase at the last meeting, to only one hawk taking up that perspective. Now, if we look at the overall sort of structure for how the Bank of England is expected to behave here, we can see the markets are not baking in cuts until we get to August. So the first cut here down from 5.25% to 5 right there in August. There's a little bit of an optionality for June, but it's August where that cut is already in the market. The second cut is already there come November, and even a little bit more than that. We can see here that another cut from 5 would be 4.75, and here we're at 4.66. So there is a slight possibility here that you've had a little bit more of a drift in the direction of a third cut, and by December, still a little bit more of a drift. So when we look at the overall structure here, looks like the markets are baking in 61 basis points in overall easing for this year. So that's obviously more than 50, so more than a pair of cuts at 25 basis points apiece, but less than 75. So the likelihood of that third cut is at this point a question of debate. And if we look at what the priced in expectations imply here based on this reading, 61 basis points amounts to something like a 56% chance of that third cut. So that's where we stand here. And if you notice, just over the past 3 days, we've gotten a little bit more dovish here, ever so slightly, from about 53 basis points to 61. And in particular, over the past day. And that's come as a UK inflation data has actually surprised on the downside. So here's the CPI numbers that we saw come out this week. Expectation was for a move to 3.5%, and we actually came down to 3.4. So a little bit soggier inflation than anticipated. And the overall structure of the inflation still relatively encouraging if you're the Bank of England, and what you want is for things to continue to come in, and for disinflation to keep moving in the direction of the 2% objective. If we look here, the makeup still overwhelmingly tilted in the direction of food and discretionary spending. And so probably the most encouraging aspect of this is that the food component of inflation, which was by far the dominant one even a few months ago, has continued to ease back. Incidentally, as we've been saying here, food has been a major contributor to inflation in Japan, inflation in the Eurozone, and a lot of it has been imported because global food costs were elevated. But we've argued here that the pass-through from global food costs, which are already falling and have been falling, into CPI is about 7 months. So in seeing that food prices were already on the decline, we could make the argument that it would show up in CPI and deflate it eventually, or disinflate it. And indeed, it seems to be occurring here. If we look at what this means, this 0 points this 0.6% contribution here for food, looked away into the wrong direction here for a second, that this is actually the weakest uplift from food costs to inflation since February of 2022. So a 2-year low for the contribution of food inflation to the overall total. Very encouraging. And the other two big ones are recreation and hospitality. And in looking at this, I think it's important to keep in mind here that the makeup of this inflation, as we've seen in the US, as we've seen elsewhere, is overwhelmingly on the goods side of things. So if we consider here what is essentially these two components, recreation, hospitality, and we ask ourselves, well, what kind of inflation? What kind of hospitality? Are we talking about the price of goods in those spaces, or are we talking about something else? And indeed, if we take a look at the price of goods relative to services, goods inflation at this point is just 1.1%. Services is at 6 year on year. So when we look at this, it's recreation services, hospitality services, where inflation is stuck. And that's mainly a question about sticky wages, because, of course, when those workers were being massively hoovered up as economies were reopening following COVID lockdowns, their wages were locked in at relatively elevated rates. There was a big shortage of labor. And so, as in the US, in the UK, the story has been, how do we get these rate hikes to squeeze labor markets and ease back some of this and unstick this from the labor market as a contributor to inflation through sticky wages? And progress seems to be underway. Job vacancies are moving steadily lower. In fact, they peaked quite some time ago and continue to normalize. They're almost to where they were averaging before the pandemic, call it 2018, 2019 or so. Wages are weakening. And if we take a look at sort of how this comports historically here, job vacancies are at their lowest since May 2021 at this point, and wage growth is at its weakest since July of 2022. So we seem to be making some progress here. Now, on top of inflation heading lower, consumers seem to believe that this is in fact occurring. So the kind of inflation expectations that might be baked into consumer behavior are easing back as well. In fact, there was a survey published by the Bank of England just last Friday that showed that if we look at where consumers think inflation is going, there's been a very significant adjustment. And of course, this matters quite a bit, because if consumers think the price of something is going to be significantly higher in the future, what they're going to do is they're going to go out and buy it if they can, expecting that it's going to be more expensive later. Now, on the one hand, that of course is a tailwind for the economy. On the other hand, it also helps to feed inflation and keep it moving higher. And that, of course, is not good news if inflation coming down is what you're after as the central bank. What you see here, though, if we look at the white line here, is the expected year-on-year inflation rate over the next 12 months has fallen considerably over the course of the past year or so, and now going into this year is sitting essentially at 3%. If the Bank of England continues to push this, they are ostensibly on a path to get to where they need to go. Very encouragingly here, the expectation for where inflation is going to be in 12 months' time after that, so in 2 years or in 5 years, they've all kind of remained anchored. So we haven't really had runaway inflation expectations settling in for the long haul. All of this should give the Bank of England more confidence in saying, okay, we need to start thinking about getting closer to these rate cuts. And the sense of urgency here for them is ostensibly greater than, let's say, the Fed, because we've just had a little shallow recession in the UK. They clock this as mechanically 2 consecutive quarters of negative growth, and indeed, that is exactly what we've just had. And so we can see here, this is the Citigroup Economic Surprise Index here, and what you find is UK economic data since about late last year has increasingly underperformed relative to forecasts. Not only that, but it's actually below the zero line here. So it's saying that data is tending to come in softer than forecasts. And so the urgency here to actually give growth a bit of a lift seems to be significant enough that if inflation is in fact starting to go the Bank of England's way and they can begin to extrapolate more in a direction of being on a glide at this point that feels more confident to 2%, that signaling less reticence in easing starts to become appropriate. And that can come in a variety of ways. Of course, that can come by way of a reshuffling of this voting pattern. It can come by way of the policy statement. The Bank of England also is very much in the camp of maximum central bank policy transparency. And so not only do they release a statement, there's also going to be a press conference with Governor Andrew Bailey. And rather than other central banks that make you wait to see minutes from the meeting, they're going to release them concurrently. So we're going to get a transcript, not verbatim, of course, but a kind of edited, editorially massaged, as it were, outlook and summary of the discussion that the MPC had to reach whatever decision they reach, and a policy statement, and a press conference, and this voting tally. So there's going to be a lot here for markets to digest. And if the sum total of all of it lands us in the direction that the Bank of England is perhaps a little bit closer to cutting rates than farther, then the implications for the British pound might be very interesting. So what we saw here in the wake of the Fed is a bit of a pop, clearly, but that pop has pointedly fallen short of overtaking the bounds of the breakdown here that we saw earlier, let's call it from the start of March onward. We very clearly kind of attempted to break this top, failed, slumped back into this digestion area, and most recently, here was the sticking point on this, right near these tops right there. We moved through it, and on the retest after the somewhat dovish bias that the markets interpreted from the Fed, we couldn't get back above this sort of area here. And so as the Bank of England comes here, if they do in fact offer a bit of a softer tone, much as the RBA did earlier in the week, which sank the Aussie dollar, we could see a reversal from this resistance heading back down with some initial support here right above the 126 or so figure, and then the bigger kind of line in the sand right here at 125, 125.40 or so. If we were to break higher, if the Bank of England were to not comply with all of our prognosticating here and continue to be resistant on cutting, or at least setting the stage for it, or if in fact the markets have already kind of written off that they're going to inch a little bit further in a rate cutting direction, shrug it off and basically say the story here is a weaker dollar, let's keep going, a break back north of the 128 figure basically sets us up for a run to 129. The high there on the June contract for British pound futures, 128.94. So call it 129 essentially. So that's how this seems to be setting up. But the interesting bit in the price action appears to be if you get a Bank of England that loosens the rhetoric, then you hold here and then extension downward follows. And that's what we're going to be watching here looking forward. And with that, we conclude today's edition of Macro Money. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it means and what it might imply about what's coming up thereafter. We've been lucky enough to be graced with Thomas Westwater's presence this week, and we're hoping to see Chris come back soon enough, perhaps even for Futures Power Hour, show that I do with him on Fridays. We'll see how that goes. I'm back on with Tom and Victor for First Call on Sundays, looking at the way that the market's open for the week and what tone that sets. I'm writing for the news and insights portion of tastylive.com. In fact, a summary of this very analysis is sitting there already as I speak, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading. See you tomorrow.